everyone, a very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is the show where we get you in touch with your personal finances, whether it's investment, insuring yourself, saving money, or even how to spend it in the right way. In today's episode of the show, we decided to bring on board our Meet Your Fund Manager segment to get all you mutual fund unit holders in touch with your mutual fund managers. So that's what we'll be discussing in the first part of the show. And in the second segment, we are going to be talking about motor insurance. While during this lockdown, you guys may be cooped in your houses, you're maybe working from home, it means that the usage of your car is extremely limited. So why then pay insurance premium for a year or 2 year basis when you can pay it on usage basis? That's what a lot of insurance companies have introduced as a brand new product in India. So we'll be talking about these products in the later part of the show. But for now, let me introduce Srinivas Rao Ravuri, the Chief Investment Officer with PGIM India Mutual Fund. Thank you so much, Mr. Rao, for joining us today on The Money Show. Let's start off first, by talking about PGIM Mutual Fund's key investment strategy. Of course, just like every other mutual fund out there, your units as well have succumbed to the losses that we've seen in the markets. NAVs too have declined. So for unit holders, what is your investment strategy to sort of navigate out of all of these choppy waters? Because today when anybody opens their CAM statement or their MF statement, it's all just a sea of red, unfortunately.
Yeah. First of all, thank you for having me on your show, Mubina. So coming to your point on mutual fund investments and NAVs being red for quite a few people, yes, I understand, and I think it's a challenge that we are dealing with as an industry. But I think I deal with equities, and my entire career has been equities. So here, when we are talking about mutual funds, I think we very, very categorically state that people should invest into equity mutual fund with a slightly longer time horizon. What do I mean by longer term? I would say about 5 years. So it is true that, if you look at last 2-3 years returns, most investors might be seeing a negative NAVs, but it is also a fact that, over the last 10, 15, 20 years, mutual funds have demonstrated or delivered fantastic returns to investors. So there are quite a few investors who have been invested and benefited from this kind of a wealth creation that equity funds have delivered. I think most important thing for an investor is when you're investing, into equity mutual funds or equities, you need to have a slightly longer term horizon. I think that is what is needed, because I think whether it is India, whether it is globally, economies and markets are becoming more and more volatile. So I think the kind of moves that we saw for the month of March, when markets are down globally to 20-25%, and people thought that we are in a bear market, and you see the kind of bounce back that US has seen in the last 2 months. I mean, we are again back to the all-time highs. So I think volatility is part of equities as an asset class, and the only way that one can beat this is staying put and staying and invested for long term. Coming to our investment strategy, I think if you see the fund performance of PGIM India mutual funds, whether it is the large cap fund, whether it is the diversified fund or mid-cap funds, I think we're doing extremely well in terms of peer rating or ranking. The reason for that is, I think we've been cautious about economic growth. It is now everybody knows that the economy is in extremely bad shape, but pre-COVID-19 also, economy was not in a great shape. For example, Q4, where maybe we had a 10-day impact of lockdown, the GDP growth that we see in both nominal and real is about, I think, 40-year low. So because of that, we have a portfolios which are, I would say, more cautious. We were less into companies which are leveraged, and we were more into sectors like pharma and chemical. I think that has helped us to do well. So our approach to investing is, what we use the term called GARP, growth at reasonable price. So we want, investing in equities about growth, but you need to buy them at a reasonable price. So I think broadly, this is what our approach has been. I think it is actually paying pretty well as of now.
Okay, all right. Well, yeah, that's the message that we as well have given all of our investors, that when you have to invest in equities and equity mutual funds, you have to sort of keep a long-term time horizon in mind. Okay, Mr. Rao, let's talk now about what is the stock selection process or screening process that you follow. The reason why I ask this question is because the last 2 years a lot of mutual fund investors have seen that the fund value, and more particularly in debt, maybe not so much so of course in equities, but yeah, that the fund has seen a decline in NAV because of exposure to certain companies, be it in the telecom space, be it some individual names in the NBFC space, so on and so forth. And like I said, again, it's happened more in the debt space, less in the equity space, but nevertheless, NAVs do get hit, and hence it sort of begets the question. If you could just share with unit holders, how do you ensure that only quality names enter funds belonging to PGIM?
Yeah, sure, Mubina. It's a good question. So, what we have is what we call investment universe. I'm sure every mutual fund will have an investment universe, these are like a pre-approved list of companies that a fund manager can invest in. In our case, for a company to get into this universe, we have 3 conditions or criteria. The first condition is, so we want a company's net debt to equity should be less than 3 times, excluding financials. So what is the rationale behind this condition? If you see historically, whether it is in the last 6 months or 10 years or 20 years also, where have investors lost maximum money, or where did we see wealth distraction, where stocks are down 50, 70, 80%, 10, 20% is fine, but we've seen many companies that appear to be a large blue chip companies also are down 80, 90%. If you look at, one factor that is common to all companies that are been a wealth destroyers, that is leverage, high borrowing. So we said, making money, we want to grow NAV, but most important is ensure that we don't lose money. So that is where, if we want to avoid big mistakes, if let's say we have a stock of 35, 40 stocks in each portfolio, if we can avoid owning, as you rightly mentioned, even at 2-3 stocks which are down significantly, I think that itself is a big job. So how do we avoid that? We've looked at historically, and then we've come to this conclusion that we should avoid companies with high debt. And we said anything more than 3 times, it can't get into our portfolios. The second criteria that we have is cash flows. See, revenues and profits are important, but I think cash flow is the most important. For some period, for whatever reasons, companies can manage their revenues and profits, whereas cash flows is the real litmus test. So for a company to get into our universe, again, we need to have that company generating positive operating cash flows of at least 7 out of last 10 years. So 2 points here. One, we are saying that we are looking at cash flows, not so much on the profits. Number 2 is, when we are investing into a company or doing a due diligence, we are not looking at a 1 quarter or a 2 quarter numbers. We are actually looking at 10 years numbers. So this is the second criteria we have. The third criteria we have is a demonstrated corporate governance. So we want to ensure that promoter interest are aligned to the minority shareholder interest. This is slightly subject to unlike the first 2 ones, but still it plays a very important role in stock to get into our universe. So I think these are the things that we have in place very clearly in our investment manual. Then comes, how do we construct a portfolio and what kind of exposures do we allow fund managers? So here, I think we are again a very well-defined sectoral limits in terms of how much underweight or overweight a particular fund manager can be. So these things I believe would help. One is ensuring that you generate a steady, consistent returns. More importantly, how do we minimize risk? Equity investing involves risk, so we can't eliminate risk, but how do we minimize risk? I think these processes are helping us to do better in this trying times.
Okay, Mr. Rao, it's also interesting to note that PGIM has a global fund as well, and funds that have overseas exposure have really done very well, including yours. In fact, I was just looking at some data on Morningstar, and it shows that the PGIM India Global Equity Opportunities Fund has delivered 23% return in 2020. So, if you could just talk to our viewers about that fund, because these are the kind of funds that are obviously attracting a lot of eyeballs.
Sure. I think, so we have this fund, our parent companies, associate company, Jennison Associates, manage Jennison Global Equity Opportunity Fund. So what we do is, we collect money and invest into that fund. I think for an Indian investor, this is a great opportunity in terms of, twofold. One, sitting in India, you are able to invest in global companies. And B, you are investing in rupees and you are getting dollar exposure. What do I mean by that? So an investor gives money, rupee terms to us, and we will convert that into dollars to invest in this fund. So and tomorrow when he redeems, we will redeem our units in the parent fund and convert that into rupees and give it to you. So you have the advantage of global exposure and also dollar exposure. Coming to the fund specifically, as you rightly mentioned, it has done extremely well, fantastic track record. So their investment philosophy is very clear that they believe that leaders will continue to do well, global leaders. So their investment universe is across the world. But right now, about 50% of the AUM is invested in US, about 25% is in Europe, and about 25% is in Asia. But interestingly, if you see the exposures, I think technology, healthcare, consumer discretionary. So these are the large bets that they have. The global majors right from Netflix to Amazon to Ferraris are some of the top investments in this fund. So it's a great opportunity that we are providing to Indian investors to participate in global majors and also get dollar exposure. So I think these kind of funds are very essential in terms of completing one's investment portfolio. You can't have, let's say, 50% of your savings in these kind of funds, but I think taking about 5 to 15% kind of exposure to global funds. We've seen quite a few funds, international funds, but many of them are specific to a particular country or sector. I think that's a relatively higher risk, whereas we are offering a global growth companies. I think you need to have a diversified approach. I think that's a better strategy than having a sectoral, a single sector or single geography specific funds.
Okay, excellent. Mr. Rao, just before I sort of just to get some closing comments from you. Obviously, at this juncture, with this COVID lockdown, with the economic slowdown, a lot of your unit holders could perhaps be staring at a cash crunch. And one of their options is to pause their SIP or redeem their mutual funds just to have them tide over this crisis. Of course, what would be your message to your unit holders in such a situation?
One need to have a proper financial planning. So I think that's number one. I am an equity investor. I used to think that everything should be invested in equities, but I think the crises like this clearly demonstrate that need for financial planning and having a diversified approach in the end, which includes having a contingency or an emergency fund. And a mix of debt, equity, international funds or gold, etc., etc. So that is important. And then second part is like, yes, if there is an cash flow mismatch, there is an emergency issue. I think he is bound. SIP is not a top priority, and he would tend to stop that. So if there is a financial crisis, I think that is more important than an SIP. But somebody, I've seen so many people calling and actually inquiring post the decline in March, thinking that at 7,700 level of Nifty, thinking that now the world is going to come to an end, let me stop my SIPs or let me withdraw money from mutual funds. And now, some people have done that, and we all know what has happened. Market has recovered very sharply from those levels. So if there is an economic need, financial need, one can take out money, but generally it is not a good idea to withdraw money after a sharp correction. In fact, again, if you see the history, whether it is 2008-9 or 2003 or even earlier period, whenever there is a crisis, and post that crisis, the next 6 to 9 months is where markets have delivered much higher returns historically. So if you take away money at that crucial period, you are losing out on big opportunity. So one should, when you are investing into equities, and that too for creating a long-term wealth, one should avoid doing this, taking out money and trying to time the market. I think that is extremely difficult. One should stay invested and ride the rally. I'm saying it's not the exiting when markets are down, but I think stay put. And then we have seen historically, one can make fairly decent return from investing into equities and staying invested in equities.
All right. Okay, great. Mr. Rao, we'll let you go on that note. Thanks so much for joining us today on ET Now, and just sharing PGIM's investment strategy, how the fund essentially, or rather how the AMC as a whole thinks when it comes to stock selection, screening, filtering process. Well, that of course was our Meet Your Fund Manager. We did one after a really long time, and folks, if you want to see your fund manager on The Money Show, you can simply email us on themoneyshow@etnow.tv.